tonight. I'm very excited to have Theron, and he is with Synovus Bank, and I'm going to allow him to introduce himself. But our topic is FHA mortgages. So specifically, we're going to talk about FHA, all the ins and outs, and anything that you need to know before you apply or get approved for FHA financing. So Theron, go ahead and introduce yourself to everyone and tell them how long you've been doing mortgages, what company you are with now, and just any background you want to share.
Okay, thank you, Shaheedah. Well, my name is Theron. I've been in the mortgage industry for a few decades. I'm currently with Synovus Bank. I've been there 8 months. I've been in this market, the Atlanta market, been here for 30 years. Currently, we at Synovus are capable of doing mortgages in 5 different states: Florida, Georgia, South Carolina, Tennessee, and Alabama.
Okay, very good. And tell them again how many years, you said decades, how many decades, without telling your age, how many decades have you been doing mortgages?
31.
31, okay, that's a long, so you have a lot of experience. They need to know how much experience you have. And I don't know, my internet's going out or your internet's going out, but so stick with us, anybody that's watching this. All right, so first thing, give us a basic thing. What I say in all my videos, there's only 4 types, and you can correct me if I'm wrong. There are 4 types of mortgages, either FHA, conventional, VA, or USDA. Anything, they all fall under one of those umbrellas?
Yes.
Okay, good. So we're gonna talk about FHA. So what is FHA financing?
So FHA is an organization that was founded by Franklin Delano Roosevelt in 1934. And it is the result of the Great Depression and the financial markets. Prior to 1934, the maximum loan amounts were 60% loan value, large down payments. FHA was created for the purpose, unfortunately, of only Caucasian individuals. It wasn't until the 60s that FHA changed and moved to be more inclusive and include minorities. And then additionally, once they allowed minorities to obtain FHA financing, what happened next was redlining. And redlining is where certain zip codes in certain areas of the United States are ineligible for certain FHA loans. Well, through time, they progressed and changed their format and their policies. And in 1995, they reached a point of 65% of home ownership, increased 65% by 1995, and it's because of FHA loans.
Okay.
FHA loans today is 40% of all mortgage loans. It's a great product. It's a great product. And over the years, there's been multiple years where the bulk of my pipeline for the year was FHA loans. FHA has had several changes. One thing about FHA that's interesting is that FHA is like the post office. The taxpayers don't pay into that system. FHA has its own insurance, and that insurance funds all the employees of FHA. Very unique program, and they have offices here in Atlanta, where I am.
Okay.
That's
so very
FHA.
good. Yeah, very good. And that's a good point of history with FHA loans, because FHA loans were put in place to make it more affordable for somebody that wants to own a home. For the most part. Okay.
Absolutely.
And we're having a little bit of delay, so please bear with us. I can hear you really well, but like it's a little bit delayed for me to hear your answer, but we're still good. All right, so, and FHA stands for Federal Housing Administration, right?
That's correct.
Okay, good. And then, so the next question is, what do I need to qualify for an FHA loan?
Well, to qualify for a mortgage, I have conversations with people every day. Qualify for a mortgage, income is the most important characteristic of a borrower's profile that needs to be analyzed. So FHA is looking at the stability, willingness, ability, and the stability of an individual's profile. So They're looking at 2 years history with employment and income. They're also looking at your banking history and the documentation of your assets, the job stability, whether you're overtime, commission, whether or not it's an hourly wage or salary wage. Those are some of the most important aspects. We may get into some of the details on follow-up questions this afternoon, but generally speaking, the ability and willingness to pay. Willingness is your credit. Ability is your debts and your income. They only allow you to have a certain portion of your monthly outgoing. They only allow you to have a certain portion of that, of your gross monthly income. For self-employed borrowers, that's net income. Okay,
let's talk about that really quickly. So how much for FHA financing, how much are you able to, how much debt are you able to have basically, right? How much can you borrow for FHA financing, like your debt to income ratio? What's the max they're looking at?
Okay, so let's look at an individual. Let's say there's an individual that makes $48,000. $48,000 is $4,000 a month.
Yes.
FHA is going to allow a maximum half of that. Half of that $4,000, which would be $2,000, to go towards the mortgage payment and other revolving and installment debts.
So tell people what
your question is revolving debts. Okay, so revolving debts are credit cards.
Okay.
Installment debt might be a signature loan with your credit union or a car payment.
Okay.
But revolving debts are those credit card, bank cards, department store cards.
Okay. And then other ones are credit cards. What about student loans for FHA?
Student loans, they qualify for an installment loan. And student loans have the tenure of me being in the business. I've seen FHA and conventional and VA change their philosophy on how they look at student loan debt. Currently, it is on deferred student loans for FHA, we must count 1% of the balance against the consumer as a monthly debt.
Okay.
Currently.
Regardless of what their payment is.
Deferred. That's right. That's correct. And the purpose for that is, let's say 10 years ago, there was a guideline that if the student loans were in deferment, you did not have to count that monthly payment against them if it was deferred for a period greater than 12 months after the closing. So what happened over a period of time is individual student loans were removed from deferment. The consumer was to make payments, and the payments were so steep, they couldn't afford to make the mortgage payment and the student loan payment. So the industry changed, and now they make the borrower qualify for a fully amortized payment or 1% of whatever their student loan balance. What would the payment be if the student loan was not in deferment? So they now set guidelines so that the borrower can make those payments. Everything FHA does, every guideline that they come up with is based upon delinquencies, defaults, and foreclosures. They will come up with guidelines that decrease and mitigate the risk to the FHA insurance fund. That's their top priority.
Okay, to avoid risk. So they see it. So even though you're on an income-based student loan repayment plan and you're paying $50 a month, they know if that payment plan ends or they stop offering it, can that individual still pay their real student loan payment? Is that correct?
That's correct.
Okay.
That is correct. That's what the guideline is all about. That's the purpose of it.
Okay. So they have things like you said to avoid delinquencies, avoid foreclosures. So they put different things in. So regardless of when things change, you're still able to pay your mortgage payment.
That's correct. It is for the best interest. The guideline is in the best interest of the consumer.
Okay. So our next question, we didn't talk about minimum down payment. So what is our down payment for an FHA loan? What's the least amount I can put down?
Currently, it's 3.5% of the sales price.
Okay.
That's changed over the 30 years that I've been originating FHA mortgage loans. That amount has changed. Currently, it's 3.5%. And those funds have to be all the consumer's funds. So the seller, a realtor, no one can contribute towards that 3.5%. Now the consumer can get a gift for the 3.5%, but the assets have to be the consumer's.
Okay, so that's a good point. Stop right there for a second. So we have to put down 3.5% to get approved for FHA. It has to come from the consumer. It has to come from the person taking out the loan. It can't come from the real estate agent giving you money towards, from the commission to the down payment. It can't come from the seller. But you said it can come from gift funds. Where can those gift funds come from?
That's correct. Nonprofit organizations, government agencies, and family members.
Okay, you cut up a little bit. So it's nonprofit, government agencies, and family members.
Nonprofit organizations, government agencies, family members.
Family members.
That's correct.
How does FHA know? Sorry, we're talking the same time. How does FHA know that they're your family?
There's a document that you sign, you and the family member. It's a gift letter, and there's language in that gift letter that's a federal law. And by signing to that, you're admitting that the information is accurate and truthful. And if for any reason the federal government has to do an audit on that loan, or the loan is selected for an audit, and they find that the information is incorrect. Somebody may have a girlfriend or boyfriend, and they say that that person is their fiance or it's their cousin. If the federal government finds out about that, they can initiate an investigation, and you can be prosecuted under that federal law and prison. And I've witnessed that in my career. I've seen where individuals have gone to prison for that.
Okay, so just make sure that you're a real family member. If they're giving you gift funds, so you can get, that's where down payment assistance comes in, some grant programs come in, and then make sure there's a family member. I know a lot of people that use their parents that gift them the funds, grandparents, a husband may gift the wife funds. If the husband is not on the loan, they can gift it as well, can't they?
Yes.
Okay, so those are all
correct.
Good things to know. Okay. So we have FHA, we talked about conventional. Is it easier to qualify for FHA over conventional, and why is that? Why is it easier for somebody to qualify for, because they also have a conventional for 3% down, right? A conventional home ready product that's 3% down?
Correct. That's correct.
Okay, so why is it easier?
I may be a minority. I may be in that category of a minority in this belief. I don't necessarily believe, Shaheedah, that it's easier, because you still have to qualify based upon your income.
Okay.
You still have debts. You still have debt to income ratios. All loan types are still going to have ratios, credit scores, credit history, minimum credit scores, and a down payment requirement. So even I don't know that it's easier, especially with the home ready. It could be that under conventional guidelines, there once was the minimum down payment was 5%, and FHA's down payment, generally speaking, has always been less than a conventional loan type.
Okay.
So now that Home Ready, Fannie Mae, has come out with a 3% down product with a minimum credit score of 620, I don't know that. Maybe bankruptcy requirements. So bankruptcy, you can be 2 years out of a Chapter 7 bankruptcy and still qualify for an FHA loan. Okay. The period of time since a foreclosure. Period of time since a foreclosure on an FHA loan is 36 months. Okay. FHA allows you to gross up your non-taxed income. So a person that receives Social Security or disability income, they absolutely can qualify for an FHA loan. Okay. Absolutely.
So
I don't know, in some areas, I'm sorry for interrupting, but in some areas of guidelines, it could be advantageous for an FHA loan. But at the same time, I think there's some products that are conventional and VA where a borrower can qualify more simpler.
Okay. That's good. That's good to know. I think that's a perception that FHA is just easier. So FHA is 3.5% down payment. Conventional is 3%. A conventional home ready product is 3% down payment. So would you suggest that people, when they're getting pre-qualified, see which one is best for them?
Yes, the loan officer and the buyer are able to go through that profile of that borrower to see which is best for them. You've got to, the consumer, I tell consumers every day, the more that the consumer knows about themselves, the better it's going to be for me to make an analysis of them and then tell them the options that they have for qualifying for a mortgage.
Okay, that's very good. So let's talk about PMI. So PMI is a big thing. So people don't want to pay it. It's extra fee, but FHA loans require mortgage insurance. Is that correct?
That is correct. So it's kind of complicated. So I'm going to try to break this down easy.
Okay, please.
If a borrower is obtaining a 15-year loan, then mortgage insurance premium must be paid at least for 11 years.
Okay.
Or the balance is reduced to 78% of the original appraised value or sales price.
Okay.
If the loan to value is, it's a 30-year loan and the loan to value is 90% or less, 90% or less, they have to pay a minimum of 11 years of mortgage insurance premium.
Okay.
They have to pay a minimum of 11 years. The loan to value is greater than 90%. Here's a good one for everyone listening.
Okay.
If it's greater than 90%, then mortgage insurance is for the life of the loan.
Okay.
Life of the loan, cannot get rid of it on an FHA loan. So
at the very beginning of it, let's go back. At the very beginning, so when I borrow the money, if I put less than 10%, or saying if I put less than 10% down, I always am going to have it?
Yes.
Okay.
Yes.
But if I put more than 10% down, I might have it for 11 years and then I can get rid of it.
You may. Yeah, the minimum you're going to have is having to pay for 11 years.
Okay.
It can automatically go away after the loan to value is 78%.
Okay.
After you reach a point of 78%, then it can automatically go away.
Okay. So if I only put down the minimum, which is at 3.5%, if I only put that down, I'm going to have it for the life of my loan.
That is correct.
Okay.
Now there's two forms of mortgage premium on an FHA loan. There's upfront mortgage insurance, which is going to be 1.75% of the loan amount. And that number is either paid in the loan or paid upfront in cash, 1.75%.
Okay.
That's the upfront mortgage insurance. And in two is what we just discussed, the monthly amount.
Okay, so, and if you ever watch mine, I'll put it over here. I did a closing cost video for FHA that says like that 1.75% as part of your closing cost. I find that the majority of my customers, my clients, they finance that 1.75%. Is that what you find?
That is correct. I don't think I've ever, 3 decades, I don't think I've ever seen a person pay the upfront mortgage insurance out of their pocket.
Yeah, I think it's because it's more closing costs for them. So people try to avoid that and just, if they're able to finance it, they finance it. All right, so
that's correct.
We talked about PMI, how you can avoid it, put more money down, and then over time it could get off of your loan. But if you put less than that amount down, then you're going to have it for the life of your loan, unless you do what? Unless you refinance. So you can refinance, so conventional, and then get rid of it.
That is correct.
Okay.
That's correct. If you have Shaheedah find you the property that is appreciating in value, and after a period of time, the house appreciates in value, you get to a point where you have 20% equity, then absolutely. You can refinance that property and get rid of the mortgage insurance.
Okay, excellent. So our next question is, all properties don't, so I'm working with buyers and it says no FHA. You know, these certain properties will not accept or can be financed with FHA financing. What would be the case where a home would not be eligible for FHA financing, and why?
So FHA has a minimum standards regarding the collateral. Property, collateral, synonymous. But a mortgage loan is made up of collateral and consumer. So FHA is interested in the collateral.
The house.
So say, for example, a property, that's correct. So let's say, for example, that the house does not have doors, front and rear doors. It doesn't have stairs leading up to the front door. And you're obtaining a particular type of FHA loan, then they would not meet the standard, the minimum standard that FHA has for a 203B loan.
Okay.
So they would not accept that property.
Right. And then during the appraisal process, they're going to send somebody out just to make sure it meets the minimum standards for FHA financing. Is that correct?
That's correct. And see, that is correct. And FHA can come back, the appraiser who represents FHA and the lender, the appraiser can come back and say, the property value is $200,000, but it's subject to installing new windows in their bedroom, repairing the gutters, putting interior door for the bathroom, installing a commode. And
Okay.
Those are going to be requirements of minimum standards for FHA.
Yeah, and so if a seller knows that they're missing some of those things, or their house is in like rehab status or something like that, they'll just put, so they're not wasting anybody's time. They generally will put in the listing cash or conventional only, no FHA. So they're not wasting anybody's time that does have FHA financing. Would you agree?
Yep, here's another reason.
Okay.
So yes, another reason that FHA may not accept the property is, let's say that an investor purchased the property for the purpose of flipping it, and they plan on remodeling it, and let's say they put in a new kitchen, they added a bedroom and a bathroom, and they did that work in 60 days. And
Yeah.
FHA has a minimum amount of time under their flipping statute that prevents that seller from selling that property inside 90 days of when the seller acquired it. So another reason that a borrower may not be able to obtain FHA financing on a particular property because it was flipped less than 90 days ago.
Okay, that's a good point, because a lot, again, when I'm taking buyers out, if investors have flipped properties, they may say no FHA or no FHA until that 90-day deadline has been met. And you can't even make an offer until, like by law, you can't make an offer until the 91st day. Is that correct?
That is correct. Contract,
Okay.
That's absolutely correct.
You can't even put it under contract, so like submit a contract until day 91. All right, so
That's correct.
I haven't really been numbering these questions, but we're on question number 7 and we have 8 questions total. What can I get an investment property with an FHA loan?
Great question. So FHA is owner occupants only.
Okay.
So a borrower, FHA insurance and financing is for only those individuals that are going to own or occupy that property. It's cut and dry.
Okay.
No way around it. Cut and dry.
Yes.
Simple question, simple answer.
Okay, let me make it less simple, because people, what about like duplexes? If I'm going to live on one side of the duplex, can I get a duplex with FHA financing?
You're going to own or occupy one side of that property. So once you're going to own or occupy, absolutely.
Okay, so yeah, let's make that distinction.
Absolutely.
As long as I'm going to live in it, at least one section of it, I can still get FHA financing. And this is
That's
probably
correct. You can buy up to, I'm sorry for interrupting. You can actually go up to 4 units. FHA will insure up to 4 units as long as you're going to occupy one of them.
okay. That's very good to know. And I think a lot of other like first-time home buyers, and I think this is similar to you asking the question about the gift funds. How are they going to know? how are they going to know that I live in the property or I own or
Another
occupy?
excellent question. So anyone listening to our conversation today, recognize that FHA is the federal government. And the FHA, they have a cousin, and that cousin is IRS. Another cousin is the FBI. Another cousin, the Treasury Department. And so all of those cousins talk to each other, especially when they think there's a red flag. And so fortunately or unfortunately in my career, I've seen where they've done these investigations. And so I've been involved in interrogations where FBI was in my conference room asking me questions about one of my consumers. I thought they were just asking me about the consumer. I didn't realize it was an interrogation until after 5 hours. And I looked back on the questions that they were asking me, and they were trying to find out what I knew. So anyone listening, people have gone to prison and they will go to prison. It's a federal backed loan, and the Federal Housing Administration, they've got cousins that will come after folks. So a person may think they're going to get away with saying that that's their family member, but I've seen too many cases where it backfired on individuals. Don't try it. Don't try it.
Right, don't try it. It's not worth it. And like you said, you sign a document, all those closing documents you sign, one of them that you close is that you're going to own or occupy that residence.
Yep. The loan application, and the loan officer is actually reading some of these disclosures to them. The application asks a question in declarations: do you intend to occupy this home as your primary residence? Well, some people think it's just a fluff question, and that's the question. I've been in a courthouse, a federal courthouse, where the judge or the prosecuting attorney had on the big screen behind the judge in Atlanta this question right here. When you said you're going to own and occupy it, it was a part of the case. And I saw the loan application on the screen. And the individual had indicated that they were going to own and occupy, and they didn't. And the federal government had a case against them. And so the wife went to prison for 12 years. The husband went to prison for 9 years.
12 years? That's a long time.
That one question.
That one question. Okay, let me ask you this.
Yeah,
follow up. That's a long time. Let me follow up on that question. So what if I live in the house so say that I intended to own or occupy, and I do own or occupy, but then several years down the road, I want to rent it. I want to rent it out. Now, how do I go about doing that? Like, is that allowed if I've lived in there at first, but then later I decide to rent it out?
So when you asked earlier about FHA loans qualifying,
Right.
One of the questions is, what is owner occupancy? What is that?
Okay.
And owner occupancy is defined as several definitions that have commas. One, the property is located within commuting distance of your employment. So that could be 150 miles.
Okay.
Two, you plan to live in that property within 60 days. You plan to move into the property within 60 days of the closing.
Okay.
And a year after that closing, you still reside there. But let's say that you've been in the house for 6 months and you, for some reason, decide to relocate to another part of the country or out of the country. Okay. As long as if the federal government is asking questions, as long as you're able to document that you moved out of the property for 6 months for the purpose of, then any investigation would cease.
Okay.
The guidelines say move in within 60 days, live there 12 months after the closing. But if anything happened in that period and you can document, you should be fine.
Okay. And then if I want to rent it out 2 years later, I'm fine.
Yes, you're fine for renting it out. If you had to leave after 6 months, you're fine
Okay.
renting the property after 6 months.
And I had a reason, I can go ahead and do that. Okay, so that's a very important, I think, point to make with FHA loans, and those people that want to be or invest in the future, they know the guidelines for that. All right, so this is my last one, Theron, and then I'm gonna let you tell everybody how to leave. Some of this has been frozen, so I think I'm gonna put your picture on one section of this because it's kind of frozen on your end. I'll see how the final one comes out. But the last question is, what is your best tip for first-time home buyers like trying to figure out what's the best loan type for them. What's the best tip you have for them?
Best loan type. So one of the things we discussed earlier is know your income, know your assets, know your debts.
Okay.
Know that down payment is going to be one of the characteristics. If you know that you don't have the down payment, you're going to be getting a gift for it. That can influence the loan type. If certain loan types have a minimum credit score and you know that your score is below that, that can determine the loan type. If the debt to income ratios are a particular, they may be higher than a loan type. Your loan officer is going to discuss that, hopefully, in the initial conversation.
Okay.
So the qualification of the loan is going to influence and dictate what loan type you can qualify for. Hopefully, the loan officer is going to know the loan types that are available and be able to ascertain from your description of your profile what's going to be the best loan for you. Down payment assistance sometimes is something that consumers may not understand. You have to qualify for the home loan in addition to qualifying for some down payment assistance. Down payment assistance is a product that is supposed to cater to low to moderate income households. Therefore, there's income restrictions for qualifying for those down payment assistance programs. Everyone just can't qualify for them. So
Okay.
Tips, know your profile. Know your profile. That'd probably be the number one, and that's income, assets, debts, credit history, credit score. Know
income, assets, debts, credit score, credit history.
Yes.
Okay.
Yes.
And while I don't know if we did this at the very beginning, because the FHA minimum credit score is 580, but a lot of lenders have increased what they will take. So what is Synovus offering right now? So if you're an FHA borrower, what credit score do they need to have to get an FHA loan right now?
All right. So I'm going to answer that question with a little bit of a long answer. So
okay.
With COVID-19, investors that buy all the loans from all of us lenders over America, they decided to mitigate their risk. And that meant they were not accepting temporarily certain credit scores below 660 or 640.
Okay.
So they are those, let's say your Wells Fargo, your Chase, your Cities, those big banks that buy loans from all of us lenders that do residential mortgage loans, they may buy 15,000 loans in 1 month all over America. Well,
okay.
They decided because everything that's happening, we're not going to accept FHA loans with credit scores below 660. Okay. So it's a temporary fix. We currently have an investor that will allow 640 on FHA. Most of our investors won't allow anything less than 660.
Okay.
Risk in my industry is going to be 640. So, but we have products that go down to 636. You can still obtain a conventional loan down to 620. So when you were saying earlier, right now, it might be easier for the individual who's got a 630 credit score to obtain a conventional loan because the minimum credit score is 620.
Okay.
But FHA could be 660, and there's an increase in rate if you're acquiring it at 640 or 645. Anywhere between 640 and 660 minimum score, there's going to be a bump in the interest rate. We can still get them a loan, but it would be different than the rate they'd obtain.
All right, let's say that again. Anywhere between 640 and 660, you can probably get a lower rate than somebody who has a higher credit score. What are the bumps? So 640 to 660, and then is it like 660 to 700?
Higher. All right. So 640 to 660, you're going to have a higher rate.
Okay.
You're going to have a lower rate the higher your score.
Right.
So if you were a 660 or above on an FHA transaction, then yeah, you're going to have better terms.
Better terms, okay.
Better terms. Down payment's the same, but the rate
that you're going to get is different. So people want to at least stretch at least for a 660 if they want the best rate.
That is correct.
Okay.
That's
very
correct.
Good. So you gave us all our best. Go temporarily. So with the whole coronavirus, how long do you anticipate that impacting mortgage rates or, you know, what people will accept?
I hope fourth quarter this is over.
So fourth quarter. So fourth quarter is like December, November, October. So by October?
That's correct.
Okay.
I hope so.
That's good to know. All right, Theron, I'm going to put in the description all of your contact information, but if you want to tell anybody about your website or anything like that, please do so now.
Okay. Synovus.com/Theron Barber, and Theron is spelled Theron, B as in boy, BAR, B as in boy, OUR. So Synovus.com/Theron Barber.
Okay. And I would just like to say, Theron's closed some loans for me, and he's excellent at explaining what people need to do and really walking you through the process. So I was very, you know, wanted to get him on as quickly as possible because he's excellent at explaining, particularly to first-time home buyers, everything they need to do. We did a little bit too many three-way calls, but we were able to get, you know, the clients where they needed to be, and so they would understand every step. So it's excellent. He's excellent with first-time home buyers. So thank you so much for joining me tonight. I'm sorry everyone has been frozen. However, the audio was excellent. So, you know, your face was frozen a little bit, but the audio was excellent. And I think they're going to gain a lot from this, you know, this video on FHA.
Thank you. Thanks for having me. Thanks for the invite. Your time. I appreciate you. Thanks a lot.
All right. Thank you so much and good night.